All right, so the exam as it exists right now has 32 questions. As always, it may change a little bit, and you shouldn't expect that all the questions on the exam are going to be completely covered by what I'm saying here today, but it's going to be, as usual, pretty close. So this exam does have extra credit built into it. So it's got 32 questions, and I'm giving everybody 2 extra points. So does it have 32? Nope, sorry, take that back. It's got 31 questions as of right now, and that may change, maybe 30, maybe 32, 33. But as of right now, we have 31 questions on the exam and 2 extra points for everyone. So what that means is you can answer 29 questions. If you get them all right, your score will be 29 plus 2, or 31 over 31, 100%. Right? So you get essentially 2 free questions. And that grading system is explained in more depth on the exam itself. So you can look at some examples. Also, very important to highlight, if we get to 90% participation rate in the evaluation for this class, everybody is going to get a 3rd point on the exam. And since there's only about 30 questions, that's fairly significant. So I strongly encourage you to please fill out the evaluation and get your friends to do the same thing. Tomorrow, I believe, is the last day for that. So good to get going on that. Okay. So with all the basics taken care of, let's walk through the questions on the exam. So from chapter 13A, I believe, we looked at a couple different ways to approach risk. We looked at risk in cash flows with our Bernoulli or yes-no model. And in that case, we had the objective that we had was to understand everything in our weighted average equation, promised cash flow times probability of that cash flow plus worst case cash flow times probability of that cash flow is equal to what you'd expect long run average if you kept buying bonds like that or making loans like that for 100 times. So expect one question on that where you'll know 3 of the things you need to know, and you'll have to solve for the 4th. Then also, in 13A, we looked at the way we measured risk typically for stocks and exchange traded funds. And we said we'd get a big long list of historical returns, and we'd look at those and we'd say, aggregation around the mean. We got a left tail, we got a right tail, so we can model those returns as normally distributed. Then we say the future is going to look like the past. Huge assumption, and you have to be careful about when that assumption may be right and may not be right. And so we model future returns of the stock or ETF that we're looking at as normally distributed with the average return that we found from our historical analysis and the standard deviation we found from our historical analysis. And I gave you some in-class and homework problems where I presented you with a normal distribution, and we had on the x-axis, we had measured in standard deviations centered around the mean, and we had the probabilities for different slices of the distribution, and I asked you a couple of questions about probabilities. So you can expect a couple of questions on that. And of course, you need to know the assumptions, right? We're not just about making numbers in here. You need to know what the assumptions are behind what we're doing and the key concepts here. We talked a bit about value at risk. So you need to know the definition of value at risk. And the way we talk about value at risk is a return that we expect to get 5% of the time or worse. Okay, so it really is talking about the left tail of that distribution. But I suggest you look up, write down on your helper sheet the definition of value at risk. And then we talked a bit also about volatility drag. And the key takeaway from volatility drag is if you have 2 potential investments you're thinking of and they have similar average returns, similar expected value returns, the better one is the one with the lower volatility, the lower standard deviation. And the reason for that is the more bouncing around you have, the more standard deviation, the more volatility, the higher the probability that that volatility is going to drag you down. And over a long period, the pile of money you generate is going to be less than the potential investment that has a small standard deviation. Then in 13B, we moved on to correlation coefficient and alpha and beta. And starting with the correlation coefficient, we wanted to make sure that when we were constructing portfolios of ETFs or stocks or bonds or whatever, that we could predict what the average return of that portfolio was going to be. And that turns out to be just the weighted average of the average returns of all the ETFs we put into that portfolio. We did a bunch of examples on that in-class homework concept quizzes, so expect to do that. And then we found that it's also, of course, really helpful to understand the risk of our portfolio measured by something like standard deviation of returns, volatility of returns, bounciness of returns. And it turned out there was pretty hairy math to figure that out unless we had a portfolio of just 2 stocks or 2 ETFs. And we had one equation to give us the standard deviation of a portfolio made from just 2 ETFs. So you should be able to compute the standard deviation of a portfolio of 2 ETFs. And the correlation coefficient, of course, comes into that equation. And then we talked about alpha and beta and how we got alpha and beta. Alpha and beta always come from comparing the returns of an ETF or a stock that we're interested in to the overall stock market. So we do a regression of the returns of our stock or our ETF compared to the whole market, usually represented by SPY, which is trying to follow the S&P 500. And what we get out of that regression are 3 things. We get alpha, we get beta, and we get R squared. So alpha tells us what we expect on average for our ETF to be doing when the market is flat. Beta tells us the slope of the regression. So if beta is greater than 1, it means we have more volatility than the SPY. If beta is less than 1, we have a lower volatility than the overall market. And R squared is a measure of how good our regression is. R squared tells us what percent of our ETF's returns are predictable from the return of the market. So you should know all of those 3 things. You should know that alpha-focused investors are interested in getting that positive return irrespective. So they want to have a positive intercept in the regression, and they also want to have a low slope. So they're getting positive returns irrespective of what the market is doing. And in the limit, Bernie Madoff had the awesomest alpha-focused investment strategy in the whole wide world, and it turned out that was impossible to achieve, and it was fraudulent, and it was the biggest pyramid scheme of the 20th century. Okay, and beta-focused investors reference their performance to the market. They're always saying, we want to be similar to what the market's doing, but we want to have better returns or something like that. But the key is they're always referencing the market in the context of the performance they're looking for. Okay, then in chapter 14, we moved on to costs of capital for debt and for equity. And also, what else did we do in chapter 14? We looked at WACC and stuff like that. So starting with chapter 14, you need to be able to compute an entity's pre-tax cost of debt capital from a balance sheet and an income statement. And you need to be able to, if you know the pre-tax cost of capital, which is really just the interest rate that a company is paying on all its loans and bonds and stuff, weighted average. If you know that weighted average interest rate, if you know the pre-tax cost of capital, you can always get the post-tax cost of capital, which is very important for valuing companies, and that's equal to 1 minus the tax rate quantity times the pre-tax rate. And then we looked at for equity cost of capital. The first thing we said is it's a lot harder to estimate accurately than our debt cost of capital, because with debt costs of capital, we always have a contract. So it's really easy to say, here's what should happen, et cetera, et cetera. With equity, there are no guarantees, right? So it just makes it much more difficult to suss out. So we looked at in chapter 14, particularly the details of the CAPM method for determining RE. RE being the discount rate we want to use when we're valuing an entity's stock, an entity's equity. So you should know the CAPM model, how to compute any quantity in the CAPM model. You should also know some of the fatal flaws of the CAPM model. As we learned in class, the CAPM model, despite its wide use, is widely regarded to not be a very good model, right? And one of the biggest reasons that that's true is because typically to get beta in CAPM, you have to do a regression between the stock you're considering and the market, and the R squareds of those regressions are typically really bad, okay, down somewhere in the 20s. So that's a problem too. And then again, of course, if you're doing that regression of historical returns, you're implicitly assuming the future is going to look like the past, which may or may not be a good assumption. And you need to know how to apply the NPV method to valuing an entity, maybe with a simple problem where you're given all the entity's cash flows that you expect, or slightly more complicated problems like we did in chapters 15A and 15B. So then in 15A and 15B, we looked at a total of 4 types of problems. In 15A, everything that we did was about valuing an entity to its owners. And we looked at two cases for that. One was the case where the entity was in steady state and it's going to go on forever, and we are going to be lucky enough to live forever to enjoy its free cash flow. So we valued the entity to owners in that case, and we could use the perpetuity equation. And for everything we did with value to entities, we considered the entity in steady state, either forever, if we were going to live forever and it was going to go on forever, or for at least the amount of time that we were going to own it. And when we say that, we saw that the free cash flow to owners simplified to net income. So for all our cases in 15A, the free cash flow to owners simplified to net income. The second case that we looked at in 15A, valuing to owners, was buy, manage, sell. So initially, our first cash flow, big negative cash flow, we buy 100% of the shares. And then for 2, 3, 4, 5 years, we manage the company. So we get that net income free cash flow for each of those 3, 4, 5 years. And then the next day, after the last cash flow we get from managing the company, we sell 100% of the shares of the stock. And we would evaluate those projects with the NPV method. So you just got to make sure you have all your cash flows and you discount them all back to t equals 0. If the NPV is greater than 0, it's a good project. If not, it's a bad project. And then in 15B, we did something very similar, except that we did this to a team of lenders and shareholders. And we found there were several cases where you would want to, or you would have to do that in the real world. One case is where if I want to buy 100% of a company's shares and it's got some loans outstanding, the lender typically has the right to say, if the control changes like that of the ownership of the firm, the lenders have the right to say, okay, fine, but we're exiting. So all the debt is due and callable on the day you buy the shares of stock. So I can't just get control of the firm by buying all its shares. I also have to refinance its debt. So that's case number one. Case number two is that if you want to buy a firm and you think it's a nice firm, but it doesn't have an optimum capital structure, right? So you will come in and change the capital structure when you buy it. So in that case, you got to buy all its debt and all its equity. So those are a couple cases where you might want to think about that. And so the situations we looked at for a team to come in and take over a company, a debt equity team, were just like 15A. Case number one was it's a steady state company. It's going to be steady state forever, and the team is going to be around forever to enjoy its cash flows. So in that case, we can model the present value of the cash flows as a perpetuity. And our second case was where we come in, buy all the shares of stock, buy all the debt if there is any, manage the company for 2, 3, 4, 5 years, and then everybody exits. And for the period we're managing the company, we're still assuming that in that period, at least for as long as we own it, it's going to be operating in steady state. No change to the income statement, no change to the balance sheet, et cetera, et cetera. So in both of those cases, the free cash flow available to the team during the period that we owned it simplifies to no PAT or EBIT minus tax on EBIT, or 1 minus the tax rate times EBIT, right? 3 ways to say what those cash flows are to the team in that case. And in that case, we also discounted now, not by RE, not by the cost of equity capital. That was 15A, where we were considering shareholders. But in 15B, we've got the whole team. So what did we have to use? The WACC, or the R sub WACC, the weighted average cost of capital, which includes a component of weight for the debt part of the team and the equity part of the team. So you definitely need to know how to compute the weighted average cost of capital. And also in 15B, we had a little bit of nomenclature. We said that we were interested in enterprise value. Whenever we're looking to the value for the debt and equity team, we call that the enterprise value of the firm, rather than just the equity value, which is just shareholders. And in 15B, the way that we couched it was we said there's Mr. Market's estimate of enterprise value, or the market estimate of enterprise value. And that was just number of shares of stock outstanding times price per share, plus the total principal value of the debt, which we would typically pick up on balance sheets, or it would be given to us. So that was the market's estimate of enterprise value. And that's what the team has to pay to take control of the firm, right? And then we said, we want our own estimate of enterprise value that we're going to find from the free cash flows, and we live forever, enjoy it forever, or from the free cash flows and then exiting the firm at some time. And in the case when we exit, when we're talking about the whole team, everybody exits. Okay, so two things have to happen. We sell 100% of the shares, but also all the debt contracts end, and the principal amount of debt, the amount that we initially loaned to the company, comes back in. So don't forget that. Both pieces come back in at the end. And we solve the problems in 15b also with an NPV kind of formulation. And we'll look at a couple examples of that in a few minutes. And then finally, we ended up with chapter 16, where we looked at the optimal capital structure for an entity. And we found that if we're looking for optimal capital structure for the debt equity team, that corresponded to the amount of leverage that minimized the weighted average cost of capital. So what did we do to figure that out? We just said, okay, let's assume the firm has leverage of 10%, 20%, 30%, 40%, and we'll just compute the WACC for each one of those. And then the case with the minimum WACC is the optimum capital ratio. How are we measuring capital ratio? Always D over D plus E, total debt divided by market value of equity plus total debt, right? And so we could call that the debt to enterprise value ratio, just like we did in chapter 6. So the reason why the optimum leverage ratio measured by debt to enterprise value occurs when the weighted average cost of capital is minimum, that's because if we look at the free cash flows, they all have to be discounted back to t equals 0. What's in the denominator to discount each cash flow back? 1 plus the weighted average cost of capital. So if we minimize that denominator, we maximize the present value of each future cash flow. So that's why the formulation works the way that it does. And that's pretty much it. So I will turn this off and we'll do a couple of examples.